Hey there, it's Nick Doherty from Forest Hill Real Estate, and today we're going to be going into part 2 of a 4-part series on how to calculate the numbers on a rental property. In part number 1, we went over the foundational component, which is finding out how much it takes to even invest in a rental property, and we came up with the amount on a property that costs $350,000. It costs $77,675 to invest in a property that is worth $350,000. So stay tuned. Today we're going to be going into part 2 of this 4-part series where we're actually going to be going into the income and expenses. So let's get into it. Okay, so now I've gone ahead and to save a little bit of time, I've went through and I've jotted down all the numbers, but we're going to go through them right now. So let's say that your rental property actually produces $2,000 in rental income. That's how much the tenant will be willing to pay you every month for them to live there. Now, there's other expenses that come into play, let's say laundry or storage. This is generally with a little bit of bigger places, let's say like an apartment building. In a single family house, you won't run into this. So let's just say the bottom line with the revenue that you're pulling in from your tenants every month is $2,000. $2,000 total. This is what you are taking in every month. Okay, so the expenses, this is where a lot of people get confused. What do I count as an expense? What will I be paying for? What will the tenant be paying for? So let's say, for example, purposes here, that the $2,000 is plus utilities. So the tenant will be paying for gas, hydro, and water, essentially. And then say cable, if they want cable or internet or anything like that, the tenant will be paying for that. So it's $2,000 plus utilities for the tenants. So what would you be paying for? So I've broken it down into the monthly expenses that you would incur for holding this property. So let's take a look here. So you'll have your property taxes, which will be $250 a month. Let's just say the property taxes on this property are $3,000 a year. So broken down into monthly payments, you'd be paying $250 a month. You would also have to still have house insurance, although it would drop probably a little bit because your tenant will also have tenant insurance. So let's just say you're paying roughly $100 a month. And then you'll also have your property manager that's looking after the property, so you're not getting phone calls. This will be roughly 8%, just a number. Some are a little bit less, some are a little bit more, some go up to 10%. So let's just say on average your property manager is charging you 8% on the revenue that's coming in. So you would be charged $160 for that for your property manager. And then as a number that generally a lot of people put in is 5% for maintenance. So depending on what your income is coming in for your revenue from your tenants, you go 5% of that is what you would anticipate in maintenance for your property for the month, which would be roughly around $100. Now that might not happen every month. You might not pay that $100, but you might pay $200 the next month, depending on what the repair is. But as an average, 5%. And then I also like to add your accountant, because you will be having a cost for your accountant to do your books and your accountant at the end of the year. So that I always buffer in about $100, and that might include a bookkeeper as well, depending, but I keep it at about $100 a month roughly for an accountant. And then in the past, I have actually had to pay for the water heater. I've had Reliance as one of the vendors that I use for the water heater, and they do not allow it to go into the tenant's name, so I've had to put it in my name. And I know that this is a little bit high here, $25 a month, but also it can be used as just a little bit of extra buffer to be safe. So I put in $25 a month for the water heater. And then I've also had a little bit of column down here for miscellaneous again. Maybe you're doing the snow removal for your tenants, maybe you're doing the lawn, maybe there's something else that comes up, but there's a little bit of a buffer again. There's the miscellaneous costs, and I have $50 a month, which equals roughly around $600 a year, which is a nice buffer that maybe something else comes up, maybe you are doing that for your tenant. So $50 a month. What does that all come to? So roughly right now, we're looking at $785 are your monthly expenses, although you have $2,000 coming in. So we're looking at this right here going, okay, so we have $2,000 coming in, and roughly we have $785 going out. So the next logical thing is to figure out what the difference is between this, but there's one other element that we're missing. What about vacancy? What if somebody moves out? So we always add a little bit of a buffer in for that, and this is how we end up coming up with what is our net operating income. Okay, so I've went ahead and I've just cleaned up the board here a little bit, so I'll just quickly go over this again. $2,000 in income from the tenant each month. We broke down the expenses. The total expenses per month are $785. So now what we want to figure out is what is our operating income. So it's just a simple math equation here where we take the 2,000, we minus the 785, and we come up with our net operating income of $1,215. So each month after our expenses, this is what we'll receive. But there's one other variable that comes into play, and it's the vacancy rate. Your property is not always going to be rented out. Your tenant might stay there 2 years, 3 years, 5 years. It all depends. Usually when you sign a lease, it'll be for 1 year, and then after that it goes month to month to month to month. So there might be a period where your tenant gives you the 60 days notice that's required, and they say that they're going to be moving out. So in that month, let's say that you don't have a tenant in there, or you don't fill it right away, we put in another little variable here, the vacancy rate, to compensate for that, because this could come up. So in this case, I put 2%, some people put 2.5%, some people put 3%. Again, it's up to you, it depends on the local market. I know where I am here in Aurelia, 2% is what I use personally. So we compensate for that, so 2% of 2,000 is $40. So now we have $1,215 of operating income minus your vacancy rate of $40 per month, which will give you the metric that we've been looking for, your net operating income. At the end of the month, this is what we can see that anticipate is going to be in our bank account every month is the $1,175. It's our net operating income. Once we have this metric, this is the metric that's actually going to lead us into part 3, where we're calculating the mortgage payment. So this is, we'll be able to see with the mortgage payment, is this actually a property that's workable? Is the mortgage payment more than this every month? Is the mortgage payment less than this? Is this going to cash flow? Are we break even? This is what we're going to figure out on part 3. I trust that this video is very helpful for you to run through the numbers. If you found this video beneficial, helpful, please like, share, comment below, ask me any questions. I would love to go over anything that maybe was missing for you. If you have any questions about the expenses or income or the vacancy rate or how to come up with the net operating income, I would really like to hear from you. So please share this video, comment below. I want to hear from you. And until next time in part 3, next week, when we actually figure out if this property is worth actually buying, stay healthy, stay well, and I will see you next week.